if you've been trading CFDs, forex for the last few months or the last few years, we've all struggled with a lot of different changes, whether it's access to brokers, access to trading platforms. We saw what happened with MetaTrader with tons of brokers. Then the last couple of years, the prop firm space got really weird, and a whole bunch of things we have to deal with there. And so losing access to trading certain assets because now you can't trust brokers and you want to trade a regulated broker, but you can't trade indices or you can't trade metals. And so I know a lot of American traders are kind of struggling with this, and that's led to a pretty big migration to the future side of things. And that's really the big answer, and the solution to basically all the problems is making that change. However, I understand that's not the easiest thing to do. There's the terminology that needs to change, and you need to adapt to all of that. Access to different platforms, different brokers. The risk is different. You're not using points or pips. You're doing contracts. So there's so many different changes, and that's exactly what we're going to go over in this video. By the end of this video, you're going to know the exact terminologies, the things that are relatively the same, the differences. You're going to know exactly how to use the trading platforms, how to choose between options of brokers, how to set your risk properly, how to take your first trade, how to open up a demo account. So you're going to have access, and you're going to be able to confidently do all of these things by the end of this video. So if you're ready to be able to trade futures more confidently and make that switch from CFDs to futures, let's dive into this video. How to trade futures. This is the step-by-step guide from CFDs to futures. Now, if you just have never traded CFDs before, then you could probably skip a little bit of this, but let's either way go directly into how to get this done. Now, why, right? Why are we looking to trade futures? One, you want transparent pricing on regulated exchanges. When you're trading brokers on CFDs, they can kind of just do whatever they want. This year, everyone's on the same playing field. It's coming from the CME. It's coming from New York. It's going to come from the CBOT. So fair playing field. Tighter spreads, and you're going to have actual liquidity. So real liquidity. Long-term trading costs are a lot lower. You're going to be looking at how to use micros, minis, contracts. And so this is going to allow you to trade a lot smaller right from the beginning. And then you're going to be able to build just good habits, long-term thinking with this. The biggest thing for me personally was being able to trade indices and metals. I wasn't able to do that when I was trading with a regulated broker. So even in the US, like you could trade with the Wanda, you can trade with forex.com. They're regulated, but CFDs, you're not trading, Dow, NASDAQ, S&P, gold, silver. So that's my bread and butter. So that was the biggest reason for me to go futures. And then with all the changes that were happening with, losing access to MetaTrader and having to do all these other things, prop firms started to suck on the CFD side, just not getting paid out, or just brokers or prop firms disappearing. Yeah, that was the big reason why I personally switched over. So let me know why you guys are switching over. Drop a comment below. I wonder if we all have the same reasons. But with that being said, what stays the same? And this is kind of the nice thing, is a lot of it does stay the same. So your technical analysis, your price action, everything you're doing to observe the market is basically the same thing. Nice and easy. Risk management, it stays relatively the same. So it's not a whole complex. It's not like you're trading options and you have to have a whole bunch of things in consideration. Here, the big things is just kind of the switch from lot sizes to contracts, and then, micros and minis. And we're going to go over that, so it's not going to be a big deal. The psychology aspect, the discipline, the habits, it's all the same. So it's not a massive change. There's going to be a little bit of a learning curve, but honestly, give it a week or two, and then you're like right where you left off. And at the end of the day, right, the goal. So the goal that you want here is really to be disciplined to your system, stay consistent, and especially depending on where you're at, the goal might not even be to be profitable right away. It's to learn about yourself, learn about your system, and that way you're able to take this to new levels later on. So right now, our main focus is let's understand futures, let's trade futures, and then you can pick off where you left off. So terminology. There's definitely some major differences. One, with CFDs, if you're trading forex, you're used to lots and pips. You're used to an environment where it's controlled by the broker, and you're used to leverage that can change. So if you're trading, which most people were honestly trading unregulated, there's some brokers where you're trading like 1 to 500. So you could have, $10, $20 in an account and you're doing ridiculous lot sizes that were unsustainable. And so for that reason, honestly, I feel like it was really easy to blow accounts, because especially if you're starting off and you just don't know, you can just kind of throw whatever at it. So that's what we're used to there. On the future side, we're not using lots. We're not using pips. It's contracts, ticks, points. I'm going to go over. I'm going to bridge the gap between this. In futures, you're trading on exchanges. The pricing is going to be the same everywhere. So for example, when I used to live stream and I was looking at trading, let's say Dow Jones, depending on the broker that you had, your prices could be hundreds of points differently. And so if you're trading with different brokers, it was just a mess. So having everything be the exact same across the board, way easier, way more synonymous. And honestly, it makes a social trading environment a lot simpler as well. And then same thing goes with margins. The margins are universal. It's honestly a lot harder to do. You can still go full tilt, don't get me wrong. Like, you can still blow accounts, and it's part of the process, I guess. But way more controlled, way tighter. And honestly, that's also a big thing, is you do need a bit more capital in order to trade with futures. And I think that actually builds enough of a cushion where you take demo a bit seriously. And we'll get into kind of what's required to trade futures and how much money. But these are the big things. And so now what we're going to do is we're going to bridge the gap with these terms. So lot sizes versus contract sizes. With CFDs, if you're used to trading forex, one standard lot is 100,000 units of whatever base currency that was. And basically what that meant was, if you're using a 0.01, it's 1,000 units of a lot. But to make it even way easier, a 0.01 with the lot size was the equivalent of 10 cents per pip with like Euro USD, GBP USD. So with some of the majors, that's like just to make it oversimplified. And the pip value depended on the pair that you were trading. So if you were trading USD CAD and then you were trading GBP USD, or you were trading a cross pair like Euro CAD, those aren't all the same. They were actually had different values. A lot of people didn't even know that. But at the end of the day, a lot of what you had here, you were just using a risk calculator anyways. Whether you had, you were looking up one online, or you had one directly correlated with your broker or your platform. And then I know once people started traded like MT5 and other platforms, it kind of did a lot of the math for you, which is cool. With futures, you're not using lots anymore, right? You're using contracts. And this is where we're going to get a little bit more in depth, and I want to make sure it's nice and easy. This is where it does get a little bit of annoying with futures. It's not universal. The value of a point changes based on the asset that you're trading. So if you're trading S&P, now here's another little lesson for you guys. S&P is ES. That's going to be the ticker. That's going to be what you type to look for the asset. If you want to trade NASDAQ, you're going to look for NQ, which is also kind of nice, because I'm sure you guys noticed if you're trading CFDs, sometimes it was NAS 100, sometimes it was NDX, sometimes it was US Tech. And every broker just called it different names for the symbols, which made it really annoying. With future, the symbol is universal. So there's just the same language across platforms, across brokers, makes it nice and easy. So if you're looking at NASDAQ, it's NQ. If you're looking at Dow Jones, it's YM. And then you're going to notice, there's ES and then there's MES. MES is when you're trading micros. ES is when you're trading minis. I'm going to dive into what that means too, so don't worry, don't get too confused. But right now, what I want you guys to understand is that each contract has a fixed value for the ticks and for the points. So for example, right now, you're not going to really understand this fully, but you will, so don't worry. On S&P 500, each tick is for ES. So when you're trading mini S&P 500, $12.50 per tick. There's 4 ticks in 1 point. So every point is $50. So if you're trading a mini contract on S, $50 a point. You should not trade minis yet. unless you are always, it doesn't even make sense. If you're watching this video, you probably shouldn't do it. NASDAQ and Q, micro NASDAQ is MNQ. So this is 10 times smaller. So every time you see micro, it's going to be 10 times smaller than a mini. So for example, with MES, it's $1.25 a tick, which means $5 a point. Why is it $5 a point? Remember, there's 4 ticks in 1 point. Now, I basically only look at points. The ticks, I don't really go off ticks too much, but that's my personal preference. So same thing here with NASDAQ. It's $5 a tick. There's 4 ticks in a point, so it's $20 a point. Again, you should be using micros, especially if you're just starting. So it's going to be 50 cents a tick, which is really $2 a point. Dow Jones, $5 a tick. Then now Dow Jones is different. There's only 1 tick per point. So it's $5 a point. With micro, which is 10 times smaller, it's 50 cents a tick, 50 cents a point. Okay. So what do I do with this information? How do I use this to calculate my risk? The good thing is there's a couple different things to do. One, I'm going to show you how you can kind of manually figure it out, and it's actually not that complicated. But then in a different video, I'm going to show you how you can create templates, save it to your platform, and then this way, all you have to do is click on the template, and then you'll see exactly how much you need to risk, how many contracts you need to use. So there is an amazing shortcut. Right now, we're not going to focus too much on that. That'll be in a different video. But it doesn't have to be that complicated. So just like how you didn't have to do a whole bunch of mental math and just figure out all these things for CFDs and lot sizes, there's also things, risk calculators and templates that you can use for futures to make it pretty simple. Okay, so let's break down micro and mini. So these are the differences. What are they? Mini contracts are smaller versions of full-size futures contracts. Most people are not trading full-size futures contracts. It requires a way more money. So you're probably not trading just full contracts. Even minis are bigger than what most people are trading anyways. So this is designed for people, active traders. You're working with multiple 5 figures, more so in the 6 figures. And this especially is for lower margin requirements. So example, a mini is, you're going to see it as ES. You're not going to see an M in front of it. So it's ES, YM, NQ for indices. If you're looking at, for example, gold, you're never going to see an M. When you see an M in front of it, it's because it's going to be a micro. So if you're looking at something like trading Euro futures, it's going to be 6E, pound, 6B, and there's a whole list. In another video, I'll walk you guys through everything. But for now, I just want you to know the difference between minis and micros. So again, micro contracts are 1/10 the size of E-mini contracts. So this is perfect for newer traders, and so that you get really precise risk management. Honestly, this is why I like micros, is because you can get basically down to the dollar, a few dollar range, and you're not really drastically over leveraging or under leveraging. So you're going to see for S&P, MES, NASDAQ, MNQ, Dow Jones, MYM. So that's 1/10 the size of a mini. Micros. When we get to the part where we're trading and you're doing your demo account, we're going to do the micros. Okay. So let's make this nice and simple. Why trade micros first? One, right? It's a lower cost per tick, which allows you to have a very, very specific risk control. It's still the same market structure, liquidity, it's all the same. It still pulls from the CME. And then you're going to be able to practice your system. So however you trade right now, however you have your entries, your exits, your management, all that, you're going to be able to do it the exact same way, and you're not going to risk a whole bunch. And then once you get consistent and once your capital is in the right place, then you can evolve into trading minis. But it's going to take some time, and that's fine. There's no rush. Remember that. And I have a little chart here for you guys to look at so you can see the difference between a mini and a micro, the dollar amount that it is per tick and what it is per point. So you can look at this. You can zoom in on this. I'm going to go over this in the next slide anyways. So from here, let's dive deeper, because you're probably thinking, okay, hold on. What's a tick? What's a point? let me get this down. So the key definitions, right? A tick is the smallest price movement a futures contract can make. For example, NQ, the tick size is 0.25. So when you have 4 ticks, now you have 1 point. So a full point can be made up of multiple ticks. With S and NQ, 4 ticks and 1 point. Dow Jones, 1 tick, 1 point. Nice and easy. This is going to be really important though, because for position sizing, risk management, and so you're not over leveraging. And like I mentioned earlier, you're not using lot sizes anymore, and you're going to control your risk based on how many contracts you're using, what's your stop loss in ticks or points, and then what instrument, what asset are you trading. So take a little screenshot of this if you need to, just so you can reference this when you're, trading, and you can kind of see, okay, what risk am I using? And in a different video, I'm going to walk you guys through like every single asset and what the tick value is, what the point value is, and how we can make a template with that. But for now, we just want to make sure we can start. That's the big thing, is we can start and we have confidence risk-free. Okay, so now that we have some of the terminology down and you have notes. Also, I didn't mention this, but I will be giving you guys kind of like a guide too, just like a PDF. That way you can just reference that, access the information really easily, and there'll be a checklist there so you know, like, okay, I know everything and I have everything to start practicing and trading on futures. So what are the differences between brokers versus exchanges? With CFDs, it's over-the-counter via a broker. Futures, you're trading on a regulated exchange. So what does that really mean? The broker just decides. So what's the spread on CFDs? So when you get in, are you going to get in, a few pips higher or lower or more, depending on what you're trading? And the quality of the execution is always changing. Where on futures, it's a transparent order book. So it's real time. Like there needs to be positions on the other side of your trade. So real liquidity. CFDs, the broker itself can just be on the other side of your trade. That's a whole other rabbit hole because there's different types of brokers and how that works. But if most people lose money trading, then it's basically not guaranteed, but high probability income for the broker to just take the opposite of whatever you're doing. And then from there, with futures, the execution is matched on the exchange. So they're not going against you. It's just like, okay, here, we're in. Like, you're in. Here's the trade. It's running. So there's big difference there. Definitely like futures, much better. The execution, like where you're getting filled, is for the most part significantly better. And then you technically don't have a spread. So really nice. We'll go over a little bit about swap fees and all that good stuff, but this is kind of the biggest difference. And the brokers are pulling their data from futures exchanges anyways. Now, margin and leverage. So these are just things that you should know so that you know the differences. And then, we're about to get into how do I open up my account and all that good stuff. With CFDs, like I've mentioned, they can give you a ton of leverage, which can be good, but usually it's just bad. Because, you can start with a little bit of money, and so there's a low barrier entry. Like my first account, I put $200 in there, and, I got lucky, I went into profits. I didn't make money because I only saw it in profits, and then I didn't withdraw by the time that I blew it. It was way too late. But it's easy to over leverage. With futures, you have margin when you're trading intraday, and then you need a lot more if you're going to hold over into the new day. And because there are no swap fees with futures, which is cool, but again, the margin increases. And you can look at the platform and you can get all the data for all the different assets. So you'll just see all this information. But with futures, I think it just puts you in a better position with leverage. It's a little bit harder to make terrible mistakes. But at the end of the day, you can find a way. Trust me. So costs, fees. With CFDs, there's built-in spreads and there's commissions. So, when you open up a trade, you're going to pay for it for the most part. There's different types of accounts you can get where you pay no commissions, but your spreads are wider. Or you have tight spreads, but then you're paying a bit more every time you open up a trade. And then slippage, it changes depending on every single broker. So high news events, sometimes they can really slip you to hell. So you'd always want to be mindful. In futures, you can also still get slipped. But With futures, the commission is based on the contracts that you're trading and then also the exchanges. So platform based as well. The spreads are basically non-existent. And then the data feed. So to have the right information, the right data, some of them, you're going to have to pay to just have like everything you need. Others, they'll come included. Prop firms tend to be like, here's all the data that you need. And then this is the big one. With funding, like how much you need to open up a trade, futures, you are going to need a little bit more. So, and I know a lot of this pertains more to the U.S. because CFDs outside of the U.S. are just way easier. Like you don't have the same regulations. You don't have the same limitations. So I know a lot of this is going to be catered a lot more towards US based traders. But if you do want to trade futures, you're going to want to have a couple $1,000 just to be able to trade micros and have like a pretty, still not even a huge, you can't really afford to have a huge stop, but definitely micros, a couple $1,000 is going to be it. And even before you do that, remember you can open up a demo account with basically anywhere. All right. And I'm going to give you guys some recommendations, or not even recommendations, just these are your options. So when can you trade though? With CFDs, it's 24/5. You have, New York, London, Asian, all that good stuff. Sometimes, depending on the asset, some brokers, they'll close for a little bit. With futures, basically it's like 23/5 with an hour of daily maintenance, like when it closes. Based on volatility, sometimes you'll have open or closes, holidays, same things. Markets will either be closed for the day or they'll close around, midday on the session. And then with futures, they open up at 5 p.m. Central and they'll close at 4 p.m. Central. And this is like CST. So obviously adapt this to wherever you're at. Now, this is just for futures in general. When we're talking about prop firms and trading futures, they can set up their own rules. They can kind of do whatever they want. So like, for example, if you're trading on Top Step, they'll like automatically close your trades at like 50 minutes before the market closes. So here in Chicago at 3:10. If you are using like Apex, you basically close your trades, I think, a few minutes before the session closes. So like here in Chicago, like 3:59 or something. Because prop firms can just do whatever they want. They can just make their own rules. They're their own business. And when you are trading with prop firms, basically 99% of the time, or 99% of traders, you're just in a simulated environment. So it doesn't really matter. It's just a video game in a way. Okay. So what's the difference in how they're executed? So with CFDs, the orders just go through the broker. And then how you instantly execute the market execution, you can get slippage sometimes. With futures, the orders aren't just going to the broker, and then the broker's just like, all right, cool, here we decided, sure, you're in, or not. We're going to put you kind of wherever we want. With futures, your orders are going through the book. Like, you're actually involved. You can see your trade there. It's probably, it's like an ant in the universe, but it's there. And so there is an exchange between buys and sells happening. And then you can use a market, just normal market execution. You can do limit orders, stop limits, OCOs. We'll get in that stuff you can learn about a little bit later. It's not too important right now. And then you can use the DOM so that you can see like, how much liquidity is there for positions with certain assets. Different ones, you're going to get filled really nicely. If you're trading something that just doesn't have a lot of volume, a lot of liquidity, you might not be filled the way you'd want to. So there is a little bit of a difference, but futures just feels very much real. Now, where do you open the account? All right, how do I start doing this? I understand the terminology a little bit better now. How do I start? With futures brokers, I give you guys some options here. I don't have any affiliates with any of these, so it's just kind of what it is. I would say for most of you, my recommendation is probably like Tradeovate is really easy, cloud-based, so it's just like online. You don't need to download a program or anything like that. Later on, if you get more advanced and maybe you want to do some copy trading, you can go with NinjaTrader. But you guys can play around with this. Like you can use. I've never used Edge Clear. I just pops up in a list that I was looking at. I have a couple friends that have used it, but not too many. AMP futures I've used. It's pretty sweet. You can trade on TradingView on there as well. And then TradeStation, massively popular. And there's many more. It's like this is just some, so I don't flood this whole thing. But these are all like well reviewed. They've been here for a long time. These are not some weird experimental, like, cheap, get some sort of bonus. It's just solid, regulated. And then with futures, prop firms, there's many more than these, right? But you have Apex, Top Step, My Funded Futures. There are more. And even this with prop firms, remember, they're just businesses. Businesses can fail. So you can use them, take advantage of them. It's a great resource. But remember, like, it's a business. So the whole payout process with these things, like, I've had a good experience so far with futures prop firms. CFDs definitely got, didn't get paid out several times, lost access to them. So I think with the prop firm space, like, take it for what it is, take advantage of it, play the game. However, I would say that when you are starting to get paid, like, pay yourself, keep a good percentage of, what you're making from them, and, like, use some of that and put it into an account that is just like you're actually trading in the market. And this way you're, like, thinking long term. You're thinking to build up your account into the 5 figures, 6 figures, 7 figures, 8 figures and beyond, because you just don't know with the prop firm. You don't have the same kind of ownership. So just a big difference there. I do both, but I just wanted to make sure that you guys understand that, like, prop firms are not the end all be all either. And do your own research. Here are some. I think Tradeovate is probably the easiest one to use. And then, honestly, I think Top Step and Top Step X is super, super easy, and you can have practice accounts there as well. So definitely check that out. But yeah, do your own research. And there's some cool websites that you can check out with the prop firm stuff. There's this website called propfirmmatch.com, and it'll just kind of compare a whole bunch of different ones, whether it's CFD prop firms or futures prop firms. And again, I'm not affiliated or have a sponsor with them or anything. All right, so diving in a little bit more, NinjaTrader, it's a more advanced charting. You can kind of add, like, in not just indicators, but like certain tools and certain resources to kind of make your trading experience either a bit more automated or to make it more effective. So for example, like, I use NinjaTrader to copy trade. So I have, like, Apex accounts, the whole, the 20 accounts, and then, my own personal, my funded futures, all that good stuff. And then you can use this tool, like, if you guys, maybe you've heard of it, Replicanto, and then that copies over. So NinjaTrader, more advanced, you got more features. That's kind of why that is used for traders that are kind of further on. And it's just based on what you need. Tradeovate, pretty simple, easier to use. You can use it on your phone too. So browser, phone, mobile, it's pretty nice. Basic, simple. Probably if you're going from, like, MetaTrader to futures, Tradeovate's probably the one you're going to do if you're not doing prop firms. And then, or TradingView, super easy, right? I'm sure a lot of you are really familiar with it, so you can use TradingView to practice futures, and then depending on the broker, the platform, the broker that you're using, a lot of them are connected directly to TradingView, so you kind of just log in through TradingView with the account that you have, depending on your broker. So pretty cool. It's not as advanced. There's, like, less things that you can do, but it gets the job done either way. Now, where are you going to practice on demo? You can do it on NinjaTrader if you want. You can do it on Tradeovate. Tradeovate's really easy to do it. So you can practice micros, minis, and then you can do it whether you just have a phone available to you or a tablet or whatever, or if you have a computer, laptop, you can do it there. If you are going to be doing prop firms, then I'd say, honestly, do the practice with them. Most of you, more than likely, are going to go through the prop firm side of things anyways. So if you're going to use Top Step, do your demo, do your practice account with Top Step. If you're going to do Apex, do your demo, your practice with Apex. It's going to be really, really easy. And remember, every prop firm has different rules. So be aware of that. And if you are, when you're practicing demo or on there, simulate the environment. So for example, let's say you're going to do a 50K challenge eventually with Top Step, and they give you 2,500 drawdown. Okay, just emulate the same type of experience, follow those rules, so that you're practicing for it anyways. Don't just do it as like, just to send it, like take it serious. Practice your system on there. See, practice everything that we're going over, the risk management component and the micros and the minis and different assets. So put it into work, put the practice in. From here, how to place your first futures trade, right? So what you're going to do is to do it. So whether you're doing it on TradeOvate, you're doing it on Top Step, you're going to select the asset. So let's just say MYM. From there, to take a trade, you're going to choose the contract size. So, take your first trade, just use one contract, micro contract, MYM. Choose what type of trade you want to do. So market execution, a limit, etc. And then from there, once you, basically open the order, either you're in right away or you're going to wait for it to hit to your price. And what we'll do is this. We'll do one together here real quick. So I have a practice account here pulled up. And so let's say we wanted to take a position here. Now, right now I have MNQ here pulled up. That's the chart. But if you are going to open up a contract, you want to make sure that the contract here is the right one. So let's say MNQ. So this is the micro NASDAQ. And then this is the order type. So if you want to get in right now, you would click how many contracts you want. I'll just put one. And then from here, we can just decide what we want to do. So let's say you wanted to just buy. And there we are. We are now in the market. With futures, remember, you don't necessarily have the same type of stop loss or take profit. Since we just bought, in order to cancel this trade or to exit the trade, there needs to be something on the other side of it. So if I just bought and I'm up here, then I would actually sell one contract in order to close this trade. So check this out. Let me hit this button now. And that closes the trade. So now you sold the buy order that you opened. Same thing. Let's say we sell here right now. So now we are shorting. So we want the market to go down. In order to close this idea, then we would buy. So if you're in a sell and you want to exit this trade, you can close it manually. Or what we could do is here, if you want to close this, you would just set a buy limit. So let's say right there, let's say I wanted to get out, whatever, just right here, 22,960. So I'd go to limit, plug that number in here, 22,960. And then if I'm opened one contract, I only want to close one contract. So I put my limit here, and this is going to be a buy limit so that when the market gets down to here, it would trigger the buy limit. So it would buy one order at this price, and it would close the sell. So it's opposites. So here we go. Now you can see it there. If the market were to drop here, it would close the idea. And then, yeah, basically, or if you just want to close it, you can just do this right here. Boom. All right. So from here, let's go back into the slides. You can practice this in whatever. So whether you're doing this with TradeOvate, you're doing this with, it doesn't matter. It's a similar process. It's not the platform isn't going to look the exact same, but this is what you want to do. You want to find the asset that you're trading, what the order is, how many contracts, and then you open up the positions. All right, so let's get back to the slides. Okay, so you just open up your first trade. What I would recommend is if you're watching this, stop watching for a second, or just keep it going if you want to keep listening to me. Go and do it. Go and do what we're doing here. Now, if you want to wait till the end, then make sure you do it at the end. What you don't want to do is just watch another video and then do nothing. It won't get you anywhere. Now, calculating risk in futures. This is a big one. I could have separated all this, but I wanted you guys to have one video to just basically do the whole thing, figure it all out. So this is going to be the basics of this. There's definitely other ways that are more effective, but it takes more time and it's using templates and stuff. But this, at least you'll have a base knowledge of what to do. So let's say we wanted to trade MYM. With MYM, so this is the micro contracts for Dow Jones, it's 50 cents per point. Okay, so that means if the market went from 22,000 to 22,010, that's 10 points. And if you bought and it went from 22,000 to 20,010, so it went up 10 points, you would make $5 if you're using one contract. So let's say you want to take a trade. So you have to choose how much you want to risk. All right. So let's say we're going to risk $1,000. All right, well, how do I know what contract size to use? Well, you need to know a couple things. How much do you want to risk? The points value. So if you're trading micro Dow Jones, then you know, oh, okay, it's 50 cents per point. And you need to know, well, how many points am I going to be risking? So how big in points is your stop? So let's say we had $1,000. Okay, I want to risk $1,000. The points value, so for every point, it's 50 cents. And it's going to be a 50-point stop. So 50 point is what you need. So you do 1,000 divided by 50 cents divided by 50 points. That'll give you 40 contracts. This is micro, right? Micro contracts. Okay. Now, if we were trading minis, this would be a different story. It'd be $1,000, and it wouldn't be divided by 50. Why? Because with a mini, it's $5 per point. So we'd actually be dividing $1,000 divided by 5 divided by 50. So that would leave you with 4 contracts. Here's an easier way. If you figure out how many contracts you need for micro Dow Jones, and you wanted to know, well, what would that be in minis? Just divide it by 10. So 40 contracts for micro Dow Jones, divided that by 10, you'd be trading 4 minis. So you can do this with tick values. That's a whole other thing. And look, you can figure this out, but also you can save this and use it as a template for quick and easy risk calculations. And you know what? I'm going to do this for you guys really, really quickly. Check this out. I'm going to do an in-depth version of this in a future video, but I'm going to give you a quick little shortcut. And I'll leave the rest to you guys. But check this out. So let's say I'm trading micro. This is micro NASDAQ. Now, let's see who's been paying attention, right? What's the value of 1 point for micro NASDAQ? Now, here's a shortcut, and this, at least I do with Top Step. So you can double click the short or the long position. And what you're going to put here in the lot size section, this is what you're going to put for the value of a point in that asset. So for micro NASDAQ, it's 2. So it's $2 per point. And then you'd put how much you want to risk. And then you could save this. I have saved like basically every single asset here. But you can save that. But now, what this will show me is here, if I wanted to risk, because I chose how much I want to risk. So in this example, I chose, let's say I'm choosing $1,000 risk here. $1,000. And it's $2 per point because I'm trading MNQ. This number is going to be different for any asset that you trade. But here, this is the cool thing. If I'm going to get in right there, it'll tell me, hey, if I put my stop loss right here, if I put my stop, so in this case, this would be a buy stop, because if you're selling, if it goes against you, it's going to take you out here. So if I got in there, I could do 11.62 contracts, micros. If I did that, then this would be $1,000 risk, and I would lose 1,000 if it got to here. So I'll just give you an example here. Market. I'm going to do 11 contracts. This is 11.62, so I'm going to under leverage slightly, but we'll do that right there. 11. I'm in here now. Now, you noticed this here automatically put certain things right here. It put the exit and then profit and at a loss. Now, the only reason this showed up here is that because I have a setting in the Top Step side of things here. I have a setting here where whenever I open up a trade, it automatically will create a $1,000 risk and a $2,000 profit based on the contracts that I opened. This isn't by default. So you can set that up. That's a nice little trick that you can do. And if I were you, I would just save this. So save it as a template, what we just did. In another video, I'll show you guys step by step how you can do this. Okay? We're almost there. So now we have risk down. We're almost done. What are the difference between prop firms? If you've been trading CFDs, there's a little bit of a difference. With CFDs, it's simulated. With futures, it's still simulated. So it's all a little video game. With futures, the chosen ones, the elite, the cream of the crop, you'll transition into real market conditions. But basically, what they'll just do is they'll all the money that you made that you have in your sim account, in your eval, or in your funded account, in your PA, they'll just move it to a real account, and then you're just trading your own money. So you can do that. That eventually happens. But for platforms with CFDs, you have like MetaTrader 4, 5, CTrader, TradeLocker, MatchTrader, DXTrade, and a whole bunch of other ones. With futures, you have NinjaTrader, Trade TopStack X, Rhythmic, Wealth Charts. There's plenty of them. Now the rules of the prop firms, this is where they get different, and this is where you really need to pay attention. If you're going to do a prop firm, don't skip out on the rules. They are different, and even within the same type of trading environment, they're different. So even in futures prop firms, there's different types of rules. And with CFDs, you have a static drawdown. Depends on if you're doing two phase or one phase. Usually you don't have trailing drawdown, but again, it depends on what you're doing. And then the profit targets, usually like 8 or 10% if you're doing two phases. If you're doing one, it's like 6% or something. With futures, they give you a limit on how many contracts you can use. The drawdown is trailing. So, for example, let's say you're trading a 50K and they give you 2,500 of drawdown. Well, once you go up in profit, that 2,500 drawdown kind of follows you. So if you're at 50,000 and your drawdown would normally be 47,500, because that's 2,500 of drawdown. Well, let's say your account goes up to 51,000. Well, that drawdown also follows. So it wouldn't be 47,500 anymore. It would be 48,500. Also, you need to make sure you're aware of, is it end of day balance in which the drawdown limits update, or if it's equity based. If it's equity, that means that if you go into a whole bunch of profit, even if you didn't close that trade, they're going to move that trailing drawdown based on even where it was floating. So be very careful. Look at the mark. Look at the rules. All right. There's a difference between end of day balance, trailing drawdown, and equity, trailing drawdown. Consistency rules. So with some of these, passing them, sometimes you don't have rules of like how much you can make max per day. Some do. Top Step, I think like the max you can do in one day to pass is like 50% of the total target. With it just depends on the prop firms, right? So check that out. And then you can't swing trade. So they're going to close your trade with prop firms on futures before the day ends. Scalability wise, you can scale, but obviously with both, it just requires discipline. The cost is different here. It is cheaper upfront to do futures prop firms, but usually once you pass, then there's more fees to activate them and a whole bunch of other things. So then they add up and they basically become the same. With CFDs, the upfront cost is more. So for example, a 50K account with TopStep is like $50. Apex, it's like the same thing. With CFDs, it's a couple $100. So the fees, they kind of even out if you are passing them. If you're not passing them, then it is cheaper with futures. But also with futures, some of these accounts, you're paying every month, whether you pass it or not. So keep that in mind. And then payouts, it's the same thing. They're both coming from a simulated pool. So basically, whether it's CFDs or futures, you're not getting paid through the market. The company's basically paying you for your service. So basically, they're just paying you out of the profits that they make from the money that they make with the challenges. That's kind of the business. It's not like you're actually extracting money from the markets. Eventually, like once you're funded and then they move you into a live market conditions, then yeah, you're now trading in the markets. Okay, so what you can and can't do in futures trading? You're going to trade real exchange traded markets and like transparent pricing, depth, liquidity. You use micros, mini contracts, maybe full eventually to scale based on your accounts. You're going to build discipline. So you're going to do this structured, good risk management, guys, systematic ways of trading. This is the way to go about this. Trust me. Over time, as your development evolves, all right, you're going to get better and you're going to be able to access different assets and up your sizing. And then, take advantage of basically no spread and being able to have and trade anything. Now, what you can't do is the over leveraging is not quite the same, which is a good thing. Yes, you can't take $10 to $1 million. Sorry. But you have a better chance of actually lasting in this. You can't ignore the margin requirements. So, got to follow that. Again, it's just kind of basically protecting you in a way. And then the prop firm side is a little different, right? Expect futures prop firms to provide more like free, like higher leverage, which this is a big thing is with prop firms, you're able to trade contract sizes that you wouldn't normally be able to trade. So that's a big difference between prop firms and then just like the actual brokers. Is with prop firms, they definitely give you more margin. So you are able to trade bigger, faster. But remember, they're all simulated anyways. Now, to shift from CFDs and futures on like the mindset, psychological side, it's going to feel more real. At least it did for me, because you're now getting filled with like actual liquidity. So it's not just like still a simulated environment. The leverage, there's no more like, well, you could still flip accounts, but it's not as aggressive in a way. And then it's way more based on just precision. So going and working with micros is going to be a big thing. It's like, it's kind of like trading 0.01s or, 0.10s, and you're not just going straight to trading lots. I think with futures, it's similar. Like, it requires you to just be consistent. It requires you to have your entries in just a systemic process. So you don't need to have multiple entry models. You're good with just one. Same thing with your exits, like just master an entry, master an exit, master management, master risk management, and you'll be able to grow way more effectively. Same thing, like when you're trading this, know exactly what the risk is. Don't rush the risk management component just because you're still kind of figuring it out. Go through it. It's a little bit of a learning curve, but you'll figure it out, especially once you watch the video that comes out in the future about how to create templates with this. You're going to be stoked because it's going to save you so much time and you'll be able to do it. But don't skip this. Same thing goes. If you weren't journaling before, start journaling. Start documenting your trades. Start learning about your habits and your behaviors. Like, you don't have to journal forever. You don't have to be 15 years down the line. Like, I've been trading for 10. And do I journal everything flawlessly like I did before? Not really. But it's still really useful. And to be honest, even when there are moments where I'm like, man, I probably would have avoided this little losing streak had I been a bit more thorough with my journaling, or I would have been able to catch my thought process a little bit better. So do it. Just do it. You're going to have to do it eventually. Just build the habit now. And then I do think that futures kind of puts you in a longer term mindset on scaling, building up your capital, and thinking, 5, 10, 20, 30, 50 years down the road. So it is all about consistency. So, okay. Final stretch. So to recap, right? You now understand why futures is such a powerful just way to trade. Yes, there's a little bit of learning curve, but it's worth it. You can see there's tons of similarities, and yes, there are some differences, and now you've been able to bridge the gap with it. You've now learned how to open up an account, how to set up your platform confidently, and you know how to calculate your risk. So experiment with this, right? Use a practice account. Don't throw money at this right away. Use a practice account, play around with micros, play around with it until you start to really get it down. And then once you do, and you have a system and you've kind of grown into yourself as a trader, then you can experiment with futures prop firms trading if you want. Start with a small account and then work your way up. Remember, you're going to learn what your risk parameters are through experience. There is no universal risk rule. Yes, it's the typical max risk 1% to 2% of your account. I would say only do that even if it's your personal and you have tons of experience. Prop firms, futures, 1% risk is probably too heavy for you. And at the end of the day, you're going to learn about what your tolerance is with risk. It's not the same for everybody. You might have a lower risk tolerance, but that's what allows you to trade well. Someone else might trade with more risk, and they've learned to work with that, and it works for them. It may not work for you, and that's totally fine. Because at the end of the day, it's what works for you. That's what matters the most. So your next steps, guys, get started with futures checklist. There's a link below. Follow it step by step so that you just don't mess anything up here and you're able to do this with confidence and with clarity. Take your first trade, so don't take too long to do this. Otherwise, you're just going to have to come back. I mean, I guess it'll work for me. You come back and you watch the video again, and then I'll get more views. So, I mean, sure, if you want to do that, do it. But at least what you should do is hit the like button right now, subscribe right now, and then you should take your first trade for sure. Join the community. I have a free trading community. We have like a hilarious, like hundreds of hours of free videos in there, whether it's from starting from scratch, learning smart money concepts and narrative-based trading like I do it, learning how to build your own trading system, and hundreds of hours of trading psychology that I've done over the last like 7 or 8 years in there. Check it out. We have a PDF, a whole bunch of good stuff in there. So that'll be linked below too, that you guys can join. And then watch the rest of the playlist that's coming out for futures trading and to accelerate your learning curve with trading. If you're watching this right when it comes out, give me a couple days and then videos will be dripping. And then any other questions, just drop a comment below. I'm active in the comments. I'll give you guys some answers. And obviously, if you're in the community, then you're going to get answers all the time anyways. So, guys, you're crushing it. If you've got to this point, like, you're a legend. Most people don't have the attention span to do all of this. So drop a comment if you got to the end. Let me know. And it's been a pleasure. My name is Mike Navarrete, and yeah, man, I'm excited to see you guys continue crushing it here. There's going to be more videos somewhere over here, and yeah, appreciate you guys. Share this with someone that also needs to make the transition from CFDs to futures, but keep crushing it, and I'll see you on the live stream. I trade every day from Monday to Friday, live right here, so I'll see you guys. Peace out.